Oracle is in a strange position right now. Its cloud business is growing fast. Revenue is up. It has hundreds of billions of dollars in signed contracts. And at the same time, its stock is down more than 60% from its peak, while S&P has cut its credit rating to BBB-. That is one step above junk. This does not mean Oracle is about to go bankrupt. The company still makes a lot of money, and large businesses are not suddenly removing Oracle from their systems. Changing an important database is the sort of project a company announces in January, delays in March, and stops mentioning by September. The problem is not Oracle's old business. The problem is how much money Oracle is spending to turn itself into a major AI infrastructure company, and how heavily that plan depends on OpenAI. For most of its history, Oracle developed enterprise software and sold it to thousands of companies. Selling another license did not require a new building, and customers tended to stay because replacing Oracle was expensive and unpleasant. AI data centers work differently. Oracle has to pay for buildings, power, cooling, networking equipment, and GPUs before customers can start using them. And Oracle is spending a lot. During fiscal 2026, the company spent $55.7 billion on capital expenditure, up from $21.2 billion the year before. Total revenue still reached $67.4 billion, up 17%, and cloud infrastructure revenue grew 77%. But free cash flow came in at negative $23.7 billion. So Oracle had record revenue and burned almost $24 billion more cash than it generated. Both things can happen at once. It is just less relaxing when you own the stock. To pay for the expansion, Oracle raised $43 billion in debt and another $5 billion by selling equity during fiscal 2026. It expects to raise roughly $40 billion more in fiscal 2027 through a mix of debt and equity, including a $20 billion stock sale program. Oracle says it does not expect to issue more debt during calendar 2026. That sounds better until you remember the $43 billion it already raised. The borrowing section has not been neglected. At the end of the fiscal year, Oracle reported roughly $122 billion in total borrowings. S&P also considers future data center leases when it calculates Oracle's financial risk. According to the rating agency, Oracle has around $260 billion in additional lease commitments that are expected to begin over the next several years. Those bills are not all due tomorrow. But once the data centers open, Oracle owes years of payments whether the buildings are full or not. Now we get to the number Oracle would rather everyone focus on, $638 billion. That is Oracle's remaining performance obligations, or RPO, expected revenue from contracts that have been signed but not yet completed. The number was $138 billion a year earlier. But RPO is not cash. Oracle expects only around 12% of the $638 billion to become revenue during the next 12 months. Most of the rest is spread over several years. Some of the risk has been reduced. Oracle says customers have either prepaid for or directly supplied around $75 billion worth of GPUs. That means Oracle does not have to finance every piece of hardware itself. The bigger concern is who those future payments are coming from. S&P estimates that OpenAI represents roughly half of Oracle's total RPO. OpenAI has reportedly agreed to purchase about $300 billion of computing capacity from Oracle over 5 years, beginning in 2027. That works out to an average of around $60 billion per year. OpenAI reportedly generated about $13 billion in revenue during 2025 and announced $122 billion in committed new funding this March. It has money and is growing quickly, but the gap between its current revenue and its planned computing purchases is enormous. For the Oracle deal to work as planned, OpenAI has to keep growing, keep raising money, and eventually turn that growth into enough cash to cover these commitments. It cannot have 2 excellent years followed by a quiet one. The bills continue through the quiet year. This also explains why other companies are becoming involved in financing OpenAI's expansion. SoftBank secured a $40 billion bridge loan partly to fund its investment in OpenAI. NVIDIA is reportedly discussing a guarantee of up to $250 billion connected to a huge OpenAI data center project in Ohio. The NVIDIA arrangement may change or never happen. But NVIDIA would effectively use its stronger credit to support a project that would eventually be filled with NVIDIA hardware. Everyone involved benefits if AI demand keeps growing. If it does not, they will have a much less enjoyable conversation about who actually agreed to carry the risk. There is another issue here: the debt and leases can last much longer than the hardware. Data centers may be leased for decades. GPUs can become outdated after a few product generations. They do not need to become useless, they only need to cost more to operate than newer hardware. Oracle could therefore have plenty of AI demand and still make less money than expected if customers start preferring newer chips, cheaper models, or more efficient systems. The data center does not become cheaper just because the hardware inside it is no longer the first choice. Regulators are starting to pay attention to this risk as well. Wisconsin now requires some large data center customers with weaker credit to provide collateral. The state does not want ordinary electricity customers paying for new power infrastructure if a giant project fails or leaves. Oracle challenged those rules in court. Because of its credit rating, the company could reportedly be required to provide more than $7 billion in collateral for one Wisconsin project. Oracle would prefer not to have $7 billion sitting around as reassurance for the electric company. The electric company feels differently. UK regulators also named Oracle, Amazon, Google, and Microsoft as critical providers to the financial sector. This is not a promise to save Oracle. It means regulators will supervise how these companies handle outages and other operational risks. So Oracle is important enough to receive special oversight, while also sitting on the lowest investment-grade credit rating. That is an unusual place for a company to be. There is still a very real chance that Oracle's strategy works. Cloud infrastructure revenue grew 93% in the latest quarter. Some customers are paying for their own hardware, and Oracle expects about $90 billion in fiscal 2027 revenue. If the data centers fill up, Oracle could end up with a much larger cloud business. But Oracle has given itself very little room for things to go wrong. A construction delay, weaker demand, trouble raising money at OpenAI, or a sudden improvement in chip efficiency could leave Oracle paying for infrastructure before that infrastructure produces enough revenue. So I would not say Oracle is finished. I would say it has placed a very large AI infrastructure bet on top of a stable software company, funded with debt, equity, long-term leases, and future customer payments. Most importantly, Oracle does not merely need OpenAI to survive. It needs OpenAI to keep growing and paying enormous bills on schedule for years. If that happens, Oracle may finally catch up in cloud computing. If it does not, Oracle could become the first major company to show what happens when the AI spending boom runs into the credit market. For years, other companies worried about becoming too dependent on Oracle. Oracle may now understand the feeling. If you want more videos breaking down the business behind AI, subscribe. Thanks for watching.